Hey out there, thanks for tuning in. I've been away for a few days on vacation. Good to be back. So today I was talking to some dear friends of mine. They're moving out of state and they're going to be buying a house, somewhere around $300,000. The question came up, should we use cash or should we get a mortgage? So I think, and I'm making an assumption here, I think the peace of mind that comes along with being debt-free is really important to my friends. It's important to everybody. It's important to me too. However, if you've watched previous videos of mine, I'm all about maximum leverage and using other people's money. I'm not talking about maximum leverage and using other people's money willy-nilly so that I waste money or anything like that. I want to either make money using other people's money or I want to save money. And that's what we're going to be talking about here. Does it make sense to get a mortgage, taking into consideration the peace of mind that comes along with being debt-free? In my opinion, it does. Matter of fact, there's a little subliminal message here. Don't use all cash. So look, the leverage, the pros and cons. Oh wait, somebody crossed out cons because I don't see any cons. The only cons that go along with having as much leverage as possible is if you do it not thinking, if you're just going out and creating as much debt as possible and not taking into consideration the benefits of using other people's money, or you're not making money on other people's money, it doesn't make any sense. But we're going to assume that that's not the case here. Using other people's money to grow wealth. If you could, let's just say for an example, let's say you could borrow money at 3%, which that's today's interest rates. Let's say you can get a mortgage at 3%, and you had money tied up in some kind of a mutual fund or stock market, very, very low risk, at 5%. Then how about borrowing at 3% and making 5% and making some money on that? It just makes sense. However, again, the peace of mind that comes along without having any debt is just such a powerful thing to some people. It's hard to overcome, and I can understand that. The rates are so low today, like I just mentioned. They're around 3%. 3% on a 30-year conventional loan. They may tighten up or the rates may go up. The paradox with getting loans is when you need a loan, you can't get a loan. Something's out of whack. You either have too much debt or something's, I don't know, your debt to income ratio, your credit's messed up, something. But when you need a loan, you go out there and try to get one, you are groveling to try to get one. However, the paradox is when you don't need a loan, everybody and their brother's knocking on your door trying to give you money. It puts you in a position of strength. It puts you in a position that if everybody wants to get your business, you can get the best deal possible out there. You could possibly get a mortgage with zero fees. Anyway, I'm getting ahead of myself. What I'm going to do is I'm going to assume that maximum leverage on a $300,000 house is a $240,000 mortgage. How I came up with that is 80% loan to value equals $240,000. That means you don't have to get mortgage insurance. Mortgage insurance is just some stupid, silly thing that's in place. And don't let the term fool you. It does not protect you. It protects the bank or the mortgage company in case you default. So if you don't have to pay that, I'm recommending that you don't. 80% is a nice blend. You still got 20% equity in the property. You get an 80% loan, $240,000. Let's say you have $240,000 in a low-risk fund or stock market. I don't know how low risk. I'm not that familiar with those. And these are all assumptions. The assumption is maybe you're making 5% per year in a low-risk fund, $240,000. That's going to equate to $12,000 per year. Now, I'm going to just use round numbers, and you're going to have to put your own figures in there if I'm off. But I think I'm pretty close. 5% equals $12,000 a year. After taxes, only 15% I'm taking into consideration. You're making around $10,000 a year, having $240,000 in that fund. It equates to about $850 per month. Let's take a look at a mortgage. Let's say you have a $240,000 mortgage at 3% interest, which that is the real interest rate today. Phenomenal, 3%. The cost on that mortgage is going to be $1,011 per month. Principal and interest. I don't know what your taxes and insurance will be, but that's not relevant in this case. So you're going to be paying $1,011 per month. So initially you might say, but Harry, that's more than what I could be making. I don't know what kind of math or anything like that. Just give me 1 second. The tax benefit is about $12,000 per year. How I'm coming up with that is initially your principal and interest is almost all interest. And you can write off all your interest. So you got a $12,000 write-off for having that mortgage. That could offset the stock gains and put more money in your pocket. So, and this is a real simplistic way of looking at it. There's so many different things that you could take into consideration. You could talk to an accountant and make sure that my numbers are right, or they might come up with something that's even better. But if you could keep the money in the stock market and take a mortgage out at 3% interest and make money by keeping your money in this low risk fund, why wouldn't you do it? This money is still liquid. If after a year you say, you know what, I hate writing that check out each month to the mortgage company, even though I'm making so much more money this way, it's just a pain in the butt, then pay off the mortgage. There's no prepayment penalty. Your original $240,000 remains liquid. You could pay off your mortgage, and I say et cetera, because you have so many other options too. Now here's where it gets really neat, is you got other options. You can get creative. If you don't want the burden, and I say burden because of the peace of mind that goes along with not having any debt, but if you don't want the burden of having a $240,000 mortgage, maybe you want to mix it up. You could get a mortgage and a HELOC. So maybe you want to get a $120,000 mortgage at 3% interest, and then get another $120,000 HELOC. I'm not sure what the HELOC interest rates are today, but I know that they're not 3%. So the blended interest rate would be slightly higher than 3%. And I know I'm going fast here, but you'd only be paying money, you'd only be paying a monthly charge on the outstanding amount on your mortgage. And your HELOC would be there for an emergency. So you can mix it up like that. What about a reverse mortgage? A reverse mortgage is for anyone that's over 62 years old. I'm not going to go into detail about reverse mortgages, but they are great products. Like you can go out, borrow money on your house, and the money gets offset, and you're not paying monthly payments each month. It gets a little bit more complicated than that, but I'm here to tell you from my experience, being in the loan business, being in a mortgage business for over 15 years, reverse mortgages are an awesome product. You could lower the mortgage. If you don't want to get $240,000 mortgage, how about going out and getting a $100,000 mortgage? Put the $100,000 in an account. After a year that you're living there, if you want to pay the whole mortgage off, you can. Again, there's no prepayment penalty. But at 3% interest, I implore you to at least check out some of these options. Last thing, the next video I'm going to make is going to be about financial awakenings, the secrets of the wealthy. Till next time.